In this presentation, we will take a look at the adjusting entries related to equipment or large purchases under our simple bookkeeping method. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Remember that these adjustments are something we would expect the tax preparer or financial statement preparer to create at the end of the time period, but it's a good idea to have an understanding of what these adjustments might be and or record some of them. Note that the adjustments related to equipment and property, plant, and equipment is probably something that we do want to leave to the tax preparer and not try to attempt the adjusting entry, because it could actually complicate things rather than simplify the system. In our example here, we have two things that we're going to be taking care of. In the simplified method, we put the equipment on the books for what was paid, and it might be the case that it was financed, and there might be some differentiation in what was paid and what was financed. So that's the first thing we want to take care of. Do we have to put a loan on the books at all, and do we have to adjust the cost of the equipment? Once the cost of the equipment is settled, then we also have an adjusting entry related to the depreciation on the equipment. So, and this is the component we would probably leave to the tax preparation, because the tax software will help us to create that depreciation expense on a tax basis, which can be a bit confusing. The tax laws can change from time to time. So what we'll do is we'll just give an idea of what depreciation is, but we don't recommend really doing the depreciation entry, even if we went through the process and we knew what the depreciation entry is, because there could be variations, and there could be different types of tax depreciation that could be used in certain situations possibly, and it might be up to the tax planner in order to decide which depreciation to use. So this is one where it's really best oftentimes to just let the tax preparer and the tax software do that. If we want to then enter it into our system, we can. Now note, we're only calculating depreciation here on one piece of equipment as well, and we're going to have a very simplified method where we're basically going to say it's going to be for the entire year that we have this equipment. In practice, of course, we would have multiple pieces of equipment we might have purchased throughout the time period. So to track that, we would have to have a schedule of all of our equipment and the depreciation on each piece of equipment to get the total depreciation. So again, something that probably we don't want to track on a tax basis in our system, but just make the adjusting entry and work with the accountant at the end of the year to use their software, their tax software, to make this adjustment on a tax basis. Also note that the tax basis could differ from an accrual basis on if we're making financial statements. But again, for a simplified bookkeeping process, the easiest thing to do is to just stay on a tax basis, even though it's not best for financial statement purposes, because then we don't have to run basically two sets of books related to the depreciation expense for a small business. So anyways, the quick journal entry for depreciation is basically just to take the cost, this would be a straight line method, and then divide it by the number of years. We're going to say that we're going to have this equipment for 5 years. So if we bought this at the beginning of the year, we're going to have it for 5 years. Depreciation would be $3,000. So this is just a simplified method. The tax depreciation method will differ from this. It'll use an accelerated method typically, but it's based on the principle, the idea of this method, a straight line type method, the idea that we're going to allocate the cost of the equipment over the useful life. So let's take a look at what the adjustment might be then to record something like this. We'll open up our more simplified QuickBooks file, the QB1 file. So it's going to go into the QuickBooks data file, and we're going to open the QuickBooks 1 file and see these adjustments within it. We'll also open up our trial balance. That's going to be in the documents. That's going to be in the 2019, and I'm going to open the adjusting entries worksheet for the QuickBooks 1 file, so we can get an idea of the visual of what this would look like, this type of adjusting entries. So first we'll note that on the books we have $9,000 in the equipment. If we wanted to look at the detail for that, we can go into QuickBooks, we can go into our reports. I'm going to go to accounting and taxes and the trial balance. Change the dates from 01/01/19 to 12/31/19. So that's for the full year. We've got this $9,000. Now, the QuickBooks, the equipment account shouldn't have too much activity in it because we don't buy large equipment very often. So if we double click on this, we shouldn't see too much. We've got this one purchase that happened for that $9,000. So because it doesn't have a lot of purchases, we can then ask our client to provide any large purchase information to the tax preparer at the end of the year so that they can make this adjustment. So we put this on the book for $9,000 because that's how much was paid, came out of the checking account. But they financed the other component of it. So we can see here, if we had the documentation, then it was $15,000 was the cost, and they paid $9,000, which we saw clear the bank account, but then they financed another $6,000 for it. So then we're going to have to go back here and say, okay, we're going to have to make an adjustment and put it on the books for the full amount that was paid and then depreciate it. So that's best to see in a worksheet like this. We're going to go back to our worksheet and say it's on for $9,000. It needs to go up to $15,000. Okay, so we're just going to say that we need to increase this. So I won't go over the debits and credits, but we'll copy this here. I'm going to make a new journal entry. I'm going to skip a line. And I'm just going to say, okay, well, it needs to be equal to $15,000, and I have minus $9,000 in it. So it needs another $6,000 that needs to go there. And the other side is going to be a loan payable, because the difference is what we financed. So we have a loan payable already. This is another loan that we took on as we financed this equipment. So I'm going to copy that, right-click, copy this, and paste this down below. And that's going to be the adjustment. If I say negative this for the debit and credit and record that, then I'm going to record that in the adjusting column in the furniture and equipment equals this, making this go up to 9,000. And then I'll make this adjustment in the loan payable equal to this, and that'll increase the loan account. This is really two loans that happened here. So now if we sum this up, it's still in balance. There's no effect on the income statement. And now we have the equipment what it should be. And now we need to do what would affect kind of taxes, which is the depreciation on the equipment. So what we would do then on the depreciation is record this side, record this 3,000. And that journal entry would be debit to depreciation expense. So I've added that here, depreciation expense. I'm going to right click on that and copy that. Put that here, right click and paste 1, 2, 3, just the values. And that's going to be for, we said 3,000. And then the credit's going to go to accumulated depreciation, which is this one. I just added that too, by the way. So right click and paste it 1, 2, 3. And then if we record this, what'll happen, depreciation, this is going to be the expense now. We're only expensing part of the $15,000 we paid. And the other side is going to reduce the equipment, but it's going to go in a Contra equipment account. So Contra asset account. So what happened here now, we're saying, okay, the equipment was actually worth $15,000. $6,000 was financed that we owe. And we're going to reduce the value by $3,000. So if we net these two out, it's really worth $12,000 now. That's the book value at least. And then we increased the equipment, we expensed it. We got to expense, which would reduce the taxes if this was tax depreciation. And that's what's going to lower the net income. We currently have a loss here going on our net income. So that's how that adjustment might look. We could, of course, put this into QuickBooks as well, and we could do the same thing in our trial balance, and we're in QuickBooks, and go to the company file, make journal entries, and then just make these as of the end of the time period, 12/31/19, and we'll make the first one for the loan. So that's furniture and equipment and loan payable. So furniture and equipment, and that was for the amounts that we financed of $6,000. And we're going to say ADJ equipment loan, and then the other side is the loan payable account, ADJ equipment loan, and then that should do it. And so then I'll go ahead and save that. If we go back to our trial balance, then now this is on the books for $15,000, and we have our loan, which has been increased to that $55.56, should match what we have here. Now we'll record the other side, depreciation and accumulated depreciation. So we'll go back here, make journal entries in the open window. We're going to say depreciation. Now QuickBooks has already set it up. We didn't set it up, but QuickBooks is going to give us that account because it assumes that we're going to have some type of depreciation we'll have to deal with. And they were right. So we're going to say 3,000. And we're going to call this ADJ depreciation. and then accumulated depreciation, which once again QuickBooks will have in there because they set it up, and that's a kind of confusing account. So it's nice that they put that in there because it's a little confusing because it's a Contra asset account, which is kind of weird. And then we'll put that here and save and close. And now we have that. So the equipment has the accumulated they put on top. Why does it do that? Because it should be underneath, because it's in alphabetical order by the category, which is furniture and equipment. So this looks kind of funny that it's on top. I wouldn't put it that way over here if I had a choice, unless I really want to line this up exactly to how I would see it in QuickBooks, which we might want to do sometime. And then the other side is going to be on the depreciation expense down here. So if you go down here, we should have depreciation expense, and there is that. Also note, if you want to check like the net income, you can go to the profit and loss from January to December, and the net income is currently a loss of $13,095. And if we go back to our worksheet, we can kind of double check that things are going as they should. This is a loss because it's revenue, which are negative numbers here, or credits, minus the expenses of $13,095. So it looks like we're all in the same area so far. For more accounting information and accounting courses, visit our website at accountinginstruction.info.